Hey everybody, in this lecture I'm going to cover some topics from chapter number 3. And basically I'm going to highlight the idea of how to use T accounts and how to complete a trial balance. So these are two really key concepts from the chapter, and you're going to use this stuff throughout your training in accounting. So it's really critical to understand this at the beginning here. So I want to go through this really carefully and give you a basic overview of the theory behind the T accounts and trial balance. And then we're going to actually go through a problem and show how transactions are actually categorized using the T accounts, and then we'll complete a trial balance from those transactions that we did with the T accounts. So first off, before we even get into the problem, I just want to talk a little bit about why we use T accounts, what they're there for, and how it differs from what we've dealt with up to this point in the course. If you remember in chapter number 2, we looked at some transactions and we utilized the accounting equation to actually categorize those transactions. So if you remember, one of the very first examples from your book talked about Carolyn Wells. She had opened a CPA firm and she had donated $100,000 to her new business. So she took $100,000 out of her own personal savings account and put it into the business. So we know from that example that we looked at the accounting equation and her cash went up 100,000. So we went under cash, or under an asset, cash, put plus 100,000, and also the equity went up 100,000. And we did that basically for a bunch of different transactions for her. If you review through chapter number 2, you can kind of see some of those examples. What's different about chapter number 3, we're actually going to utilize the accounting equation, but it's going to be more theoretical. It's going to be in the background. And in practice, accountants don't actually categorize transactions using that accounting equation. There's some companies that have thousands of different accounts and millions of different transactions. They don't have a huge, big whiteboard with an accounting equation they're categorizing things through. They actually use T accounts. They look at individual accounts. And so today we're going to look at how we actually utilize these T accounts to keep track of transactions. So we can see over here, this is a really important page from your book. This is near the end of chapter 3. And it shows you how to utilize T accounts. It shows you for each individual account what happens, what side gets increased, what side gets decreased. So for instance, let's first isolate on this asset account. Notice this little plus sign means if we have a transaction and we know an asset is going up, we have to find the T account for that asset, and we want to put the entry on this side, the left side, because it's an asset, and we can see from this, assets go up on the left side of the T account. Notice we call it a debit entry. Anytime we make an entry on the left side of the T account, that's a debit. On the other side, we have credit entries that happen on the right side of the account. Now, for an asset, we could see the minus is associated with a credit. So when an asset goes down, for instance, we use cash to pay a bill. Well, we have less cash. We know that asset is going down. We'd call it a credit entry, and we'd make it on the right side of the asset T account. And this will make a little more sense when we actually go through some examples with numbers and show you what's going on. Notice liability accounts are a little bit different. Remember, assets are things that we own and have control over, like cash or accounts receivable or supplies, equipment. Liabilities, that's debts that we owe. So accounts payable, that's an example of a liability. A bank loan that we have to pay back, that's another example of a liability. Now notice for liabilities, again, if we make an entry on the left side of the T account, that's a debit. It's always a debit on the left side. But notice that entry decreases that account. Recall over here, if we made an entry on the left side of an asset account, that recognizes that it's going up. Well, with a liability, it's actually going down. Notice a credit increases a liability account. We make an entry on the right side of the liability account, that means the liability went up. So let's say that we have an accounts payable. We actually received some goods, but we didn't pay for them immediately, so we owe a vendor some money. That means that liability just went up. We owe more money to that particular vendor than we did before that transaction. So that's an increase in a liability. That would be a credit. We'd hit the plus side over here, the right side of that particular T account. We could see also for other different types of categories, we have different rules. Owner's capital, a debit decreases it. All right, so if we make an entry on the left side of a T account for owner's capital, that means our capital is going down. If we make it on the right side, that's a credit entry for owner's capital, it's going up. The whole reason that we actually use these T accounts is to get rid of pluses and minuses. Remember when we utilized the accounting equation last chapter? What we did there, if we had cash going down, say we paid a bill for $10,000, we'd have minus $10,000 under that asset, under cash. Well, here, utilizing the T accounts, we don't use a negative sign. We just put $10,000 on the right side, the credit side of that particular T account. So just to kind of recap for these last three accounts, owner's drawing, that just means the owner's taking money out of the business. Well, if that happens, money's being taken out, all right, we have a debit. We make a debit, that's plus, and this is a little bit tricky with this one here. The plus means we're drawing more money out. More money's been taken out of the business. All right, the credit would be the opposite side of that, and that's usually only used when we're making a correcting entry to that account. Revenues, for the T account for revenue, make a debit. All right, that's on the left side. That means a decrease. All right, generally we have increases in revenue, right? Our revenue goes up. We perform a service, for instance, and we make $1,000. Well, now our company earned $1,000. We want to make an entry on the right side of the T account. That's a plus entry. All right, expense account's just the opposite. If an expense goes up, all right, we incurred a new expense and it increases, we put that on the left side, the debit side of the T account for the particular expense. All right, over here on the right side, that indicates that an expense account's going down. So that's just a theoretical overview. I know when I first show students this, it's a little bit confusing. So actually going through an example here should help clarify what we're going to do. So this is going to help you get some practice actually utilizing our T accounts. So first off, I want to look at our beginning balances for this particular company that we're going to work with through this example. So we're looking at Dom's delivery service, and notice that Dom's balances for his accounts as of June 1 are given here initially. All right, so at the beginning of June, Dom has $23,350 in cash. That's his account balance. It's showing how much cash he has on hand. He has $14,600 in accounts receivable. That's how much folks owe to him. That's kind of his IOUs that he's in possession of. He has $450 in supplies, so that's just a grand total of all the supplies he owns. He has $12,800 in office equipment, $20,000 in delivery equipment. Notice these first 5 items here. These are all assets. These are things that Dom has ownership over. We get to this next line item, accounts payable, $6,900. If it's a payable, that means his company is due to pay somebody in the future. He owes them $6,900. All right, so that's called a liability if it's a debt of the company. Now notice all these things over here, they fall under equity. Dominic Goggins' capital, $64,300. All right, that's how much capital, how much equity he has in the business currently. Now notice these other accounts, the drawing, fees, income, and all these expense accounts, they have a zero beginning balance. The reason they have no balance is these are temporary accounts. We close them out at the end of the period, the end of the month, for example. So if we're trying to calculate our income for June, remember, if we want to calculate net income, that's just our revenue coming in minus our expenses. Well, we don't want to take into consideration what we earned in revenue or what we incurred in expenses for May. We just want to look at June's number. So when June starts, we close out all these. We have zeros in all these accounts. Notice it's different for our assets and liabilities. Those are a running total. And remember, our balance sheet shows all of our assets, liabilities, and equity. So that's showing how much cash we accumulated over time. Where do we stand right in this one point in time as far as our cash total goes? Same deal with liabilities, accounts payable. This is how much we owe at one point in time. When we're looking at these revenue and expense accounts, that's for a period of time. How much income did we earn for a month or for a year? So a little bit of a different idea. Key thing I want you to take from there, expense and revenue accounts, we close those out at the end of the month, so we'd expect to have a zero balance going into a new month. Our assets, liabilities, kind of different. We should probably normally have some type of balance for those accounts. So basically, this is what we're starting off with for Dom. Now, we're going to have a number of transactions that occurred throughout the month. What we want to do is utilize the idea of T accounts to categorize these transactions. So we can see over here on this sheet, we have all the different accounts for Dom. Notice we have supplies. His beginning balance for supplies was 450, so that's why that's right there. What we're looking at on this sheet is actually a completed key for this particular problem. So all the work's already been done. I'm going to go through each part of the problem step by step so you guys have an idea of how to complete a problem like this. You will actually see a problem like this on your discussion board for this week. Now notice we have 13 different accounts over here, and we're going to have 13 T accounts. We have supplies, delivery equipment, office equipment, cash. And notice our starting balances for each one of these accounts we transfer over to the T account. So for cash, we have $23,350. That was the balance, all right, at the beginning of June. So that's where we start at. Notice we have all these different transactions here for cash, and we're going to get to those in a minute. I'm going to show you guys how we actually calculate and why we put those numbers on each side of the T account. We're going to look at all the transactions for the month and show how cash changed. This total down here, $18,900, that's where we're going to end up at the end of June. That's going to show us how much cash the business has at the end of June after we take into account all the transactions we're going to work through. Same deal with all these other accounts. And notice I have a second page here where I have some other accounts listed below. Last part of this process, we're going to go through, utilize these numbers to complete our trial balance. All right, so let's actually start working through this example here. So we have these transactions, A through J. For each one of these, we're going to try to categorize them using the accounting equation. All right, so the first transaction, Dom paid rent in June for $1,000. So the first thing we want to do is try to figure out what accounts are being affected here. Well, if we paid rent, we're paying cash, we know we have less cash. So that's the first entry we want to make. Notice we want to look and figure out, well, what side of the T account do we want to use? Well, we know we have less cash, right? If we had more cash, we'd make an entry on this left-hand side. Well, we actually have less cash, so we're going to make it on the right side. It's a credit to cash. So notice over here, transaction A, all right, I have a $1,000 entry, and we call that a credit entry because we're making it on the right side of the T account, a $1,000 entry to cash. So that's one part of the entry. Now, the other thing we have to figure out is what's the other side of the entry. For every amount of credits for a particular transaction, we have to have an equal amount of debits. So I know, in addition to cash, something else is being affected. Well, think about that. If we paid $1,000 for rent, that's an expense. That's our rent expense. Well, if we come up here to this T account, notice if an expense goes up, it gets debited, right? We're making an entry on the left-hand side. So what we want to do is come over here, find our expense account. Notice there's our rent expense. Transaction A there. We put $1,000 on the left side of that T account. All right, that's a debit to our rent expense. And notice we had no starting balance for rent. And this is actually going to be the only transaction that affects the rent expense. We can see at the end of the month, our balance is going to be $1,000. All these other transactions we have going on here, none of them actually affect paying rent. We paid it once at the beginning of the month. It's not going to be affected again. Notice up here with cash, I showed you guys already our beginning balance. We've seen that first 1,000 entry. We're going to have a lot more entries affecting cash as we move along. So we're going to look at the sum total of all those entries to figure out how much cash our company has at the end of June. What's the balance of our cash account? So let's move on to our second transaction. Dominic withdrew $4,500 from his business for personal use. Well, again, we want to think about what accounts are being hit. Well, we know first off, if he withdraws money, that means he's taken money out of his business. So the business has less cash. Cash is going down by $4,500. So we know our cash account's being affected. Well, I got to decide which side of the cash T accounts I want to hit. Well, again, I go up to this. I look, well, if I make a debit, that means our cash is going up. Well, it's not going up. It's actually going down. We have less cash. The guy took money out of the business. Well, that means we have to make an entry on the right side of the T account. We have to make a credit entry, all right, to show a decrease. We can see here, this is transaction B. And over here, transaction B is listed on the right side, $4,500. Notice we don't put a minus sign there. That's the whole rationale behind using these T accounts. We're not going to deal with minus signs anymore. We make an entry on this side of an asset T account, that means it's going down. Cash is an asset. Made an entry on this side showing that cash goes down 4,500. The other side of this is that he took money out, so we have to look at his drawing account. All right, so if we come down here, notice we have DG drawing. Well, transaction B, we make a $4,500 debit entry to drawing. And if we want to figure out what side of the T account to hit, we come back up here. We look, okay, well, a drawing account's being affected. Well, notice drawing went up. More money was taken out. 4,500 was taken out. So we make a debit. We make a plus entry on the left side for drawing. One thing to keep in mind with all these transactions, you should have an equal amount of debits and credits, meaning there should be an equal amount of entries on the right side of a T account for every amount made on the left side of another T account. So notice we made an entry here on the left side of the drawing T account for 4,500. All right, over here with cash, made an entry on the right side of the T account, 4,500. So we know we're in balance. All right, so let's look at C here. Perform services for 4,000 in cash. So we perform some type of service, and Dom delivers groceries and other goods. So you got paid $4,000 for doing some deliveries for the month, and you got paid in cash. Well, first off, we know now we're having cash come in, so this should be getting familiar with this cash account. All right, if cash goes up, it's an asset. We know plus side is the left side of an asset T account. So we have a 4,000 entry for transaction C. Notice our first two transactions that hit the cash account, we were paying money out. Cash was going down. All right, that's why we hit the right side of that account. But now cash is actually increasing. Money's coming into our business. All right, so we recognize that on the left side of the T account. Notice now there's another side of this transaction. We performed a service. All right, that's us earning revenue. All right, so this is going to be the first time we actually hit a revenue account. And notice our revenue is called delivery service fees in the case of Dom. So different companies will distinguish their revenue accounts with different names. Dom delivers goods, so he calls this a delivery service fee. It's a fee being paid to him. So if we're confused as to what side of the T account to list that 4,000, well, we come over to revenue. Notice our revenue is going up. It went up 4,000. All right, so we make the entry on the right side of the account. We see our plus sign there. All right, so we have that $4,000 for transaction C on the right side. All right, in transaction D, again, we're performing some type of service, but it's on credit. What that means is we performed a service, but we didn't get paid immediately. Well, just like in the last example, we performed a service, so we're going to hit the fee account again. All right, we're getting revenue coming into our business, $22,750. Now notice we didn't get paid cash yet. The customer still owes us this money, but we recognize revenue, right, when we perform the service or sell a good. So even if we perform the service today and don't get paid for 2 months, we recognize the revenue today. The cash didn't come in yet though. So we know if the cash didn't come in, the cash account isn't affected. All right, this is what we call an accounts receivable. We performed the service but didn't get paid yet. So we recognized revenue, that went up $22,750. We put that on the right side because revenue is increasing. That's a credit to revenue. Well, the other side is going to be a debit to accounts receivable. So we come over here, notice transaction D here, $22,750. All right, an accounts receivable is an asset. That's something we own. Basically, we have an IOU that we own from our customers. They owe us money. All right, well, that's an asset. Notice when an asset goes up, it's a plus sign. Before that transaction, we didn't have that IOU from that customer. They didn't owe us any money before we performed the service. Now we are owed that money. That asset increased. So we make an entry on the left side of that T account. All right, 14,600 or 22,750 in that case. Notice the 14,600, that was our beginning balance. Just saying that before the month started, we had customers owing us 14,600. Well, now they owe us more. We performed a service, and we have more IOUs outstanding. So transaction E, now we received $12,000 from credit customers on accounts. All right, what that means is customers are paying us back some of the money they owed us. We performed a service in the past. All right, now they're paying us back. So two things are going on here. First of all, we're getting cash coming in, right? $12,000 is coming in from our customers. They're paying us a debt that they owe us. So we can see that here. And this asset, cash, is going up by 12,000. So notice again, assets, when they go up, that's a debit. It's on the left-hand side. But notice we exchanged one asset for another. Yeah, our customers paid us 12 grand, but now they don't owe us the $12,000. So that IOU basically has been extinguished. All right, they don't owe us $12,000 anymore. We got to recognize, all right, we're due less money from our customers now because we got paid back. So that particular asset, accounts receivable, is going down. All right, so we're hitting the credit side of that asset account. All right, so we put it on the right-hand side. Notice when our customers purchase something from us and didn't pay us immediately, all right, we put it over here. When they actually do pay us some, it comes here. The reason is that accounts receivable is going down. We have less of an IOU in that case. It went down by $12,000 when we got paid. Now, if we look at our next one, F, we paid the administrative salary of $2,000 to a delivery service driver and a salary of $3,000. So actually, you're paying $2,000 to our administrative assistant and $3,000 to a driver. We're paying two separate salaries. We're paying out $5,000 in total. So that $5,000 is coming out of our cash account. We now have $5,000 less in cash. By now, you guys are probably getting the hang of this. If cash is going out, we have less of it. It's a decrease to an asset. Anytime an asset decreases, we make an entry on the right side of the T account. We can see here that $5,000 was taken out of the cash account. And notice that was an expense to our company. All right, that's a salary expense, payroll expense. All right, well, that's a new expense. We know when an expense goes up, we make a debit entry on the left side. And when we come down here, we see that our salary expense, transaction F, $5,000. Notice that was the only transaction that hit that account. And remember, our expense account should have a beginning balance of 0. That's the only expense that be hit under that account. So our balance for that account for the month is going to be $5,000. Letter G, we paid the electric and phone bills by check for a total of $600. Now again, this is an expense. We call this a utility expense. All right, the expense went up by $600, so that's a plus. All right, that's on the debit side, the left-hand side. We can see that there. Notice the other side of that transaction is our expense gets hit. We paid an expense, but we have less cash to pay that expense. We had to take money out of our account to pay the bill, and we could see that right here, $600. Notice again, cash is going down. We're paying a bill. Oh, we have less cash. That's a decrease in an asset. All right, that goes down there. Remember, last week when we dealt with this with the accounting equation, we'd have just minus 600 out of cash. Well, now using the T accounts, we don't use the minus. We just show $600 on the right side, on the credit side to cash, indicating that our cash went down. All right, notice here in transaction H, we paid creditors $6,000 on account. All right, that means that we now owe $6,000 less to our creditors. Well, we can see again, cash is coming out of the business. We're paying off a debt, so we have less money. Again, we make that entry on the right-hand side of the asset account, the cash account. The other thing that's going to be hit is our accounts payable. Remember, accounts payable, that's a liability. That's money we owe. All right, well, we now owe a little bit less money, all right, because we paid off $6,000. Remember, liability accounts, when a liability goes down, all right, we make an entry on the left side, the debit side. And that's what we have right here. And that makes sense, right? We have less of a debt. Now we paid $6,000 to our creditors. We don't owe them as much. This accounts payable is just showing how much we owe our creditors. Well, it's going down by $6,000. Goes down for this type of account. We make the entry on the left-hand side. We purchased $7,500 in supplies on account. All right, transaction I. Well, now, again, we have less cash, right? Cash is going down. I'm sorry, this is actually on account, so this is going to be, we're buying something on credit. So cash actually doesn't get affected in transaction I. We purchased supplies on account. That just means that we bought the things without paying for them up front. We're going to pay this bill later on. Well, again, that's going to be an accounts payable. All right, notice the last transaction, we paid off a bill. We owed somebody money. We paid them back. In this case, Now we have a new accounts payable, $7,500. The amount that we owe people actually went up. All right, again, that's a liability. We make a credit, we make an entry on the right hand side in that case. The opposite side is we have more supplies, right? We just purchased some supplies. Well, supplies is an asset, that's something we own and control. All right, so it went up. We make a debit entry in that case, showing that it increases. Now, the last one we're going to look at, we paid $1,800 in cash for advertising in the local newspaper. All right, so again, we have less cash. Cash is coming out of our business. Notice we make an $18,000 entry on the right-hand side. That's a credit to cash, or that asset, cash, is going down. The other part of that transaction is that's an expense. That's a bill we had. We paid for advertising. All right, so we paid a bill. Oh, that indicates we had a new expense. All right, that expense went up. Notice expenses are over here again. All right, that's a debit. That's an increase to the expense. And again, we had a credit to cash. So for $1,800, we have to have a corresponding debit to some account for $1,800. In this case, it's advertising expense. So that's just a breakdown of how to go about categorizing these transactions. This is something you get a lot of practice with throughout the course. I know this is kind of foreign to students trying to use these T accounts. It's really just a lot of practice going through this, and after a couple weeks, this will become second nature to you guys. Now, the next part of this problem is I want to use these account balances to create a trial balance. And a trial balance is basically just a check on our work to make sure we did everything correctly. All right, so for instance, going up to the cash, let's look at this account, being this is the one that we use the most often. Remember, our starting balance at the beginning of June was $23,350. All right, then we had a bunch of different transactions throughout the month. So we made all these different entries here. Remember, the entries on this side was when cash was coming in, right? Debits, that's all the time we had cash coming in. This is all the times that cash went out. So what we're interested in figuring out is exactly what's our balance in the cash account now. How much cash does our company actually have possession of at this point after all these transactions? Well, what we do to figure that out is we look at the total of each side of the account. So we take the 23,350, add the 4,000, add the 12,000, and all together on the debit side of the cash account we have 39,350. Then we look at the credit side. We add up all the changes, all the cash going out, and we see we had 18,900 coming out. So what we want to do is compare the two sides of the accounts. The debit side is larger, so we always look at the larger side, subtract the smaller side. We take 18,900, subtract that from 39,350, we get a balance of 20,450. And we call this process of adding and subtracting these sides footing the account. So we footed the account for cash. It came out to 2,450. That's showing how much cash we now have on hand in our business after taking into account all these transactions we had for the month of June. Now notice we should generally have a debit balance for cash, and for assets in general, we should have debit balances. We call that a normal balance for an asset account. Because think of something, for instance, like supplies. Come over here for supplies. We had $450 worth of supplies to begin the month. All right, then we purchased $7,500. Well, if we foot the totals, notice we didn't even have any supplies going out here. Didn't have any supplies used up in this case. We add those up, we have $7,950 debit balance. It wouldn't make sense to have a credit balance in our supply account. That doesn't make any sense to have negative supplies. How can you own negative supplies? We're adding up the value of all the supplies our company owns. It shouldn't be negative. That doesn't really make any sense. Same deal with delivery equipment, right? That doesn't mean you won't have credit entries. If we used up some supplies, we'd have a credit entry to show those supplies were used. Maybe for some reason we'd sell some of our supplies or take them back to the store. That would reduce our supplies. But the point I'm trying to make, we never expect to have a negative balance of supplies. You will have entries in this side of the account, but this side of the account shouldn't surpass this side, except in very, very unusual situations. So the whole process of footing these accounts just means we're going to go check the debits, balance them off against the credits, and figure out what our total is. Same deal for accounts receivable as what we had with cash. We look at our starting balance, $14,600. Well, we had an increase in 22,750. Somebody purchased something off us but didn't pay us immediately, so that was an increase. But notice on this side, somebody actually did pay us 12 grand, so our accounts receivable went down a little bit because of that transaction. What we're interested in when we foot this account, we want to know right now what's the total of our accounts receivable, how much money is owed to us by customers after the effects of all these transactions. We started the month having customers owing us 14,600. Well, that went up by 22,750 because of this transaction. So you see the total of those two in the debit column, 37,350. I subtract out that 12,000, recognizing the fact customers paid me back 12 grand, so they don't owe me that money. Altogether, we're owed 25,350. Just like with the cash, we compare the total amount of the debits, compare them to the credits, figure out the difference, and for an asset account, we should expect to have a debit balance. Notice over here, accounts payable. All right, this is a liability account. Notice liability accounts, we expect to have a credit normal balance. All right, this is showing how much money we owe other vendors, how much money we owe our suppliers. All right, so we had a couple transactions here where accounts payable went up. Remember that when we made these entries, that was in the case when we purchased something on credit or on account. Basically, we bought something, but we didn't pay for it immediately. Well, the amount of money we owed went up in those cases. Our debts went up. All right, this entry over here, the 6,000, that was an example of us actually paying something off. All right, so same idea though with the liability as with the asset accounts. We want to foot the total, want to compare the credits with the debits. Notice in this case, the credits are bigger than the debits. All right, if we subtract the 6,000 in debits from the 14,400 in credits, that 14,400 just comes from adding the 6,900 and 7,500. Our total would be 8,400 in that case, 14,400 minus 6,000. That's telling us at the end of June, how much do we owe others? All right, how much do we owe our suppliers? And that's $8,400 in this case. Notice for the liability account, we should have a credit balance. If we had a debit account, or if we had a debit balance overall after we did this math here when we footed the accounts, that would indicate that we owe, or actually that would indicate that we are owed money from our suppliers. That's kind of a rare thing, right? We don't expect to be owed money from people we're buying things off of. Maybe in rare cases when we return something or we received an item that was broken and we're given a credit to our account, but that's a very, very rare situation when that occurs. All right, so for each of these individual accounts, what you're going to want to do is just tally the totals, foot the accounts. Notice a lot of these accounts here, they only had one entry. For example, for advertising expense, we only had one transaction all month that affected that account. So the balance for the account is just that one total there. So what we want to do next is look at the balances of all these accounts and use them to complete our trial balance. So this is an example of Dom's trial balance. And real simple, all we're doing is taking the balances from all those individual accounts and listing them out. So notice each one of those accounts we worked with is listed here. All right, we have our assets up here first, then our liabilities, then our capital and drawing, income, revenue, and then our expenses last. What we're going to do is just transfer the balances from those individual accounts and place them in the debit and credit columns. So we want to look at what the final balance is. For example, cash, remember, the final balance in that cash account was $24.50. If we scroll back up, all right, we see that we have a balance here of $24.50. We're just taking that, putting that down here, and make sure we put it under the debit column, right? It was a debit balance. All right, again, accounts receivable, we had a $25,350 balance for that. If we look here after we did all of our math with accounts receivable, that balance came to $25,350. So all I'm doing with the trial balance is just reproducing these numbers kind of in a different format. I'm grouping together all the totals of each of those account balances we calculated earlier. And notice here for all the assets, we have debit balances as expected. That's the normal balance for those accounts. All right, our liability account, our accounts payable is $8,400. Remember, we expect to have a credit balance for liabilities. Remember, we took that from up here. Again, that doesn't mean we'll never have a debit entry. We did have a debit of $6,000 when we paid off some of the debts we owed. What we're saying is, in general, we expect to have a credit balance there, and that's what the case was after we did our math to add up this account. It was $8,400. We just bring that down into the trial balance. All right, so the same thing with the rest of these accounts. Our capital account had a $64,300 credit balance, brought that down. The drawing account had a $4,500 debit balance. So we do that for each of the individual accounts. List what their balances are, make sure we put them in the proper category, debits on the left side, credits on the right. And then what we're going to do next is tally up the total. So we add up all these debits together, all these entries together. Notice they come to $99,450. That's a total of all of our debit entries. All right, our credits, we add them up. We only got these three guys right here. Add those together, we get $99,450. Notice that's a really positive thing because we want to see these debits equal the credits. Remember what we said earlier, for every dollar in a debit we had, we should have an equal dollar in credits. If these numbers were off, that shows us we made a mistake. That's really the whole purpose of completing the trial balance, to kind of figure out if our numbers are off. And notice the format, what we do, we always put the company's name up first, then we put trial balance down here, then we put the date that we actually completed the trial balance. So if these numbers are off, that indicates that we had a problem. We don't have an equal amount of debits and credits. In that case, we want to go back, we want to look at all of our individual transactions and see if we could find where we made the error. All right, so the trial balance is just a double check on our work. The next part of the accounting process, which we won't talk about in detail in this lecture, but it would be to actually create the financial statements. Once we know the account balances, then we can go out and use those balances and complete our income statement, owner's equity statement, balance sheet. All right, so we use these totals to complete those statements. And you guys have worked on problems in the past where I had you actually go out and complete financial statements. I gave you the account balances in that case. Right, you were given the account balances, then you went out and completed the financial statements. In this case, you guys actually had to go through the transactions, utilize the T accounts, and go and use that information to complete that trial balance. All right, so that's just a quick breakdown of how to use T accounts. I know, again, it gets a little bit confusing when you first do it. Have this, mark this page in your book, have it accessible. Throughout the course, you're going to be referring back to these over and over again. And again, after a couple weeks, it's going to become second nature. You're going to know if you have an asset and it goes up, it's going to be a debit. It's going to be an increase on the left side of the T account. If it goes down, it'll be a credit decrease on the right side. The same deal for these other accounts. After enough practice, you guys will understand this really well. All right, so please let me know if you have any questions.